Today we're taking a look at an alternate version of exercise 11-3 on page 520 of the textbook from chapter 11, Reporting and Analyzing Equity. The problem is recording stock issuance. It reads, prepare journal entries to record the following 4 separate issuances of stock. First, a corporation issues 6,000 shares of its $5 par value common stock for $54,000. In this transaction, the company is receiving cash. Well, how much cash are they receiving? Well, that's just $54,000 in cash. So cash gets debited for $54,000. The common stock account will get credited at the number of shares being issued at the par value per share. So common stock gets credited for $30,000, which is 6,000 shares times $5 per share. But since this is in excess of the amount of cash the company received, the company will credit an additional paid-in capital account, another contributed capital account on the equity side of the balance sheet, for the difference to balance out the journal entry. Paid-in capital in excess of par value common stock will get credited for the difference of $24,000. In the second example, a corporation issued 3,000 shares of no par common stock to its promoters in exchange for their efforts, estimated to be worth $63,000. The stock has a $1 per share stated value. Well, often startup companies and other companies might issue shares of stock to companies that do work for them in lieu of actually paying for those services. This is such an example. Here the company is issuing $63,000 worth of services in the form of stock. The company will take an expense like they would have if they paid for these expenses in cash. They'll still recognize the organizational expenses in the amount of $63,000. But rather than crediting cash, they'll credit for the number of common shares issued at the share's par value. 3,000 shares at $1 each, they'll credit the common stock account for $3,000. But since we're not in balance, means that the services were worth more than just the par value of the common stock, a plug to additional paid-in capital is created to balance out the equation. Paid-in capital excess of stated value common stock will receive the plug for $60,000. Remember, common stock is always credited directly at its par value. In the third example, a corporation issues 2,000 shares of no par common stock to promoters in exchange for their services worth an estimated $30,000. This stock has no stated value. Well, like the example before, the company will still recognize an expense for the value of the transaction. Here, the expense will be recognized at $30,000. The company will credit common stock, but since this common stock has no par value and no stated value, common stock will get credited for the amount of the transaction at $30,000. This is an exception to the rule. Common stock that has no stock value or no par value or no stated value, for transactions we credit that account for the entire amount of the transaction. In the fourth transaction, a corporation issues 2,000 shares of $50 par value preferred stock for $130,000. Well, first we record what the company is receiving. They're receiving cash in the amount of $130,000, so cash gets debited. The company will credit preferred stock at the par value per share for the number of shares issued, so 2,000 times $50 per share equals $100,000. And since this is in excess of the amount of cash received, the balance is a plug to paid-in capital. Paid-in capital in excess of par value gets credited for $30,000.